I hope yes. As I previously said, today class topic is market sentiment in Asia Pacific, and we try to cover three region and three countries today: China, Japan, and Australia. And also, I will focus on the trade, finance, GDP, sanctions, tariffs, and inflation data today. And here, let's start with the trade indicators by market and product. On the left-hand side, please focus on this left chart. Here, as you see, this is the Australia export exposure of our market. This is United States. By the way, this numbers showing us what is the percentage of the export as a nominal GDP with currency United States dollar and for the time of 2024. And for Australia, the export to the US is just 7% of the GDP. And India is here. And this is in United States, and this is raw materials. And please look at this one. Australia focus on their specific region, Asia Pacific side, because this country is like an outlier in the continent or like a specific region in Southeast Asia and really far away to the like the Europe, like the UK, and the transportation cost, the mobility for this region is really hard for the Australian market to make export and import for their production. And they are generally focused on the relatively close neighbors like South Korea, Taiwan, and Vietnam. And here, as you see, it is the almost higher than the third, fourth of the GDP for the South Korea, Taiwan, and Vietnam. And just the two specific cases, Japan and China, they are relatively close when we compare to the United States or the Europe. They are as territorially. The Japan and China is close to Australia, but I think the Japan and China making their most of import from United States and Europe rather than Australia. For that reason, Japan and China, despite they are close, their portion, their capture is relatively low with the Australian trade. And here, the US import by selected products. Why I am saying this? Because, as you know, the Trump administration in the 2nd of the April declared a list of the tariff to the all of the world, and almost all countries higher than 50%, even for instance for China, approximately 200% tariffs for the Chinese product to the United States. And they postpone for 90 days, except China, for EU, Japan, and those countries until the 9th of the July. And approximately 5 days ago, they declared again a list of numbers of countries, and they say that we will effectively apply these tariffs. And on the right-hand side, please look at here, from which countries and from which products the United States making imports. Please look at this one. Semiconductors, pharmaceuticals, autos, and the steel and aluminum. And here you will see the countries. Please look at this one. The role, the rest of the world for the semiconductors, meaning that if we focus on this slide, pharmaceuticals, this is billion, 200 billion, about 200 billion of the imports of the United States pharmaceutical products coming from outside the United States. And biggest part is Ireland, then Switzerland, Germany, Singapore, and India. then the rest of the world, approximately 100 billion. But what is the biggest? It is approximately $325 billion for the auto and auto parts. And biggest portion is coming from the Japan, South Korea, and Mexico. As you see here, they are greater than $200 billion. And the steel and aluminum, because it is effective rate, it has started, the Trump administration started their effective tariff rate in the side of the steel and aluminum products. And those are approximately 125 billion totally for the United States imports, and Canada, China, and Mexico are the biggest part for those products. Why this topic is important? Because, as you know, if you apply a tariff reciprocally, some countries also increase their tariff rate on your products. Then let's say today the prices is here. When you apply a tariff, the meat price is here. Then they are putting, the other country is putting a tariff here. Then you are putting here. And this tariff war, this trade war, can increase the inflation to all over the world. And today, after the COVID financial crisis, the United States, EU, Japan, China, all advanced and emerging market economies started a new monetary policy. First, decrease the interest rate. Then suddenly, when the inflation rise up, they started to increase their interest rate to fight with the inflation. And last 2 years, they are starting to cut the interest rate in the focus of the inflation output. For instance, for the United States, the federal fund market is approximately 4% and inflation is around 3%. But from 3% to the Federal Reserve target of the inflation, approximately 2%, from 3 to 2 is a little bit hard. I mean, when the COVID started, the United States inflation after the monetary policy rise up to 7%, 9%. Then from 9 to 3 is easy because it is a bubble. When you control the monetary policy and demand side, the inflation can easily drop from 9% to 3%, 6% decrease in, let's say, 1 year. But from 3 to 2, just 1% may take time over 3 years or 4 years. And Fed is really prudential about this topic. Then when the Trump increased the fight with the tariff rate and then augmented the fight to the Federal Reserve and declared to the rest of the world with social media, Powell should be signed off, right? Because he's saying the interest rate should decrease right now. Every day, Trump writes a tweet on X, and he is saying that interest rates should decrease right now. But Powell, knowing that, without the interest rate touch, if the interest rate is still constant, with this tariff rate, inflation will rise up. And if they decrease the interest rate more, inflation will be again like the COVID period. So Fed is really confidential and prudential for this process, but the political side, like in all countries, they want to decrease the interest rate, they want to increase the credit in the market, they want to increase the demand, and they want to increase the employment and GDP. But the negative side of this process is the inflation. So Fed is trying to increase the GDP and the employment without increasing the inflation. The responsibility of the monetary authority and political authority is not the same. For that reason, Federal Reserve or central banks should be independent. If they are directly dependent to the political side, you never fight with the inflation throughout the world in any other country. Then here, please look at this side, the trade for global trade flows, US food import by market. Here you will see the countries and the time. The axis, total share of the United States imports, and this x-axis showing the time frame from 2000 till now, approximately 25 years coverage. And here you will see the countries: Vietnam, China, Eurozone, Mexico, Taiwan, and South Korea. What is the dramatic country? Is China. Please look at this green line. Approximately 20% of the United States import until the 2016 coming from China, as you see. Please look at here. From 9%, it is increased approximately 22% until the 2016. Then the United States see the rising power of the China hegemony, like the make China great again. And then they put lots of measures and they trying to decrease their speed to control the world. Then the US import from China dramatically dropped during 9 years, less than 10%. Here, as you see, we are at the starting point. During 25 years, it rise up, then turn to the initial level. Okay. Which countries are stable? Eurozone and Mexico. They are stable around 15%. But which countries is increasing the power on the United States import? They are Vietnam and Taiwan. For that reason, Trump never let to the China invade the Taiwan, because Taiwan is a critical role and has a really influential importance for their imports to the United States. They are really good partners for the United States. For instance, focus on the Vietnam. If they gone up like this speed, in 5 years, they will rise up higher than the China. So with this critical power, and for instance, focus on here, as you see, we are putting the rest of the world. Yes, Taiwan is not here. But for the next couple of years, you will see the Taiwan in this list for the United States import. And please now focus on the right-hand side. What this chart's telling us about Chinese export by designation. 6-month moving average year over year. This is the percentage change. This y-axis showing the percentage change of the China export. And which countries are this? United States, ASEAN countries, and the rest of the world. The blue is the United States, black is ASEAN, and the rest of the world is the green. Please look at the United States here. China export for the United States from minus with the COVID crisis to the increase in 50%. Then suddenly after the COVID crisis, it is less than, as you see, 0. It is minus. So increasing, give me 1 second, please. Sorry for this interruption. Here, as you see, normally the China export by designation and their percentage change for the United States, except the COVID period, generally positive. But right now, with the measures taken by the United States, China cannot export to the United States. It is minus. But for the ASEAN and rest of the world, it is growing, as you see. Because you should substitute the China with the rest of the world, other partners like the Taiwan, like the Korea, like the Vietnam, or like other trade partners, because China is not a small country you can be negligible. Okay, you should find lots of strong alternatives, not basic alternatives for China. Okay, you cannot replace China with a small country like the, let's say, Malaysia. Okay, when you decide to take some measures for China products, you should take measures for years and years, because it is not such a small country. You can easily find an alternative. Okay, their trade, their power, not just the economic power, but military power, alternatives, trade connection, their hegemony on the world is really increasing. And the United States see this reality. For that reason, they are trying to decrease the speed. This is the reality, actually. And now let's pass to the macro indicators, starting with the Japan. The Japan, here GDP and inflation indicator. Here I am on the left-hand side. Please look at this chart. For the 20 years, here I'm in 2020 and 2025. This is last 5 years, okay, from the COVID crisis till now. And this table showing the first quarter GDP growth is 1.7%, and the 20-year average is just 0.6. So, what is the dramatic point here? It is this. Now Japan is growing higher than their 20-year average, and this is the answer for why the interest rate increasing in Japan. Because there is inflation in Japan right now. Because economy is growing. During 20 years, they are in the disinflation period. Their economy is almost in recession, right? Their growth is like 0%. Their budget is almost 0 or minus 1%. Because they cannot increase the demand in the domestic economy. Their average age is higher than, let's say, 50, 60. Economy is not growing. Economy is aging. But right now, with the measures taken last 10 years, Japan is growing higher than their 20-year average. And this growth creates a demand and inflation, price inflation in the market. For that reason, Bank of Japan increasing the interest rate. And when we focus on what this growth, what is the source of growth in Japan? Please look at the subcategories. Real GDP is the orange one. Private investment, light blue. Black is consumption. The dark blue is public investment. Green is the government spending, and purple is the net export. And please look at this one. Light blue. Japan is now growing with the private investment. Japan is investing. It is not demand-driven economy. It is invest-driven economy, and this investment creating employment in the market as well. For instance, if economy is just growing with demand and consumption, this is inflationary, hugely inflationary. But Japan is growing, but this growth is not just coming from the consumption and demand. It is coming from the investment. For that reason, it is less inflationary. This is healthy growth. Okay, growth is not healthy when it is just coming from the demand and consumption side, because consumption generally creating inflation, and it is not creating employment, investment, or something like that. But if it is coming from the investment, it is decreasing the prices because you are producing more, and when the production increases, the price is going down, and because you produce more, you are opening new factories and you are creating the employment in the market. And for that reason, when we focus on the Japan healthy growth side, they are doing good. And when we focus on the inflation side, here as you see, on the y-axis, we see the year-over-year inflation here on the y-axis, and here in the x-axis, the time frame from 2005 till now, approximately 20 years coverage. And normally, when we take the average, please look at this one. Average for 20 years, headline consumer price inflation is just 0.7, nothing less than 1. Normally, Federal Reserve, European Central Bank, all these countries targeting 2% inflation. These are the central bank targets, 2%. And Japan inflation is nothing, even less than 1. And now their inflation is 3.5, 5 times higher than the average. 5 times higher than the average. And the core CPI, I'm sure lots of the attendance is knowing what we mean by core CPI, but for those who don't know what we mean by core consumer price index, in consumer price index, we are calculating a basket. And we are taking this price today as a base year. Then this year, I am calculating this basket prices again. And then while calculating inflation, I'm taking the percentage change between this basket and this basket year on year. Okay, with 1 year, how this basket prices change compared to this basket. And in this basket, let's say 300 items included. But some of them are volatile, like energy, like food, like alcoholic beverage. These are like volatile prices. If I exclude these prices from the basket, then I find the core basket. This is the core consumer price inflation. And it is even less than the headline consumer price. It is just 0.0, meaning like zero. There is no core inflation in the Japan during 20 years. No inflation, no core inflation. But now in May 2025, even the core inflation is 1.6%. This is a shocking effect for the Japan authorities, monetary and government authorities, because they are not expecting such a high inflation in core and headline CPI. And when you focus on why lots of people selling the Japanese government bonds, you will find the answer here. When the inflation increase, and if the interest rate is not increased as the inflation expectation, then the real return on government bond will decrease and you will sell it. Japanese government bond sold throughout the world approximately last 6 months. Here now we are focusing on the growth indicators. Again, we are in Japan. Here on the left hand side, this is the business condition. The black one is manufacturing and the blue one is non-manufacturing. This period is crisis period. Don't focus on this because it is shrinking, really dropped approximately 40% during the COVID crisis. But normally it is around 10%. And today, non-manufacturing sector is performing better than the manufacturing in Japan. And for the consumption and wage growth, please look at the time frame here, 10 years. And this is year over year change. And this is 6-month average. And this bars showing the consumption changes. And this line for the blue is showing the wage growth. What is the dramatic for you? Consumption, please look at here. Consumption increasing around 5%, and the wage growth is around 5%. But when we are here, please focus on here, during the COVID period, consumption is increasing 6%, but wage growth is just 3%. There were no inflation. But now, with this wage growth effect, for instance, let's say, why wage growth is important for us. Let's say Karim, Abdul Ibrahim, and Sese Hules working in a company. And the boss saying that because the inflation this year is 4%, we are increasing the base salary for 5% to compensate the inflation loss. Okay, your nominal salary increased 5% to give you a favor and compensate your losses against inflation. Okay, then next year, inflation is zero. There is no inflation. Is your boss saying to you that give that 5% to me because there is no inflation? No. Your nominal salary continue like the previous one. Even the inflation is decreased, right? For that reason, wage is creating an inertia on the inflation. it is really creating an inertia, and that increase will be there forever. This is one of the best well-known indicators to show why the inflation cannot easily drop because of the wage growth. And Japan, last slide. The interest rate differential. Here, please look at this one. The black line showing the 10-year US Treasury and 10-year Japanese government bond yield spread, meaning that, let's say, 5% or 4% is 10-year Treasury yield, and let's say 3% is Japanese government Treasury yield. 4 minus 3 is 1. This is your spread between the US and Japanese government bond. This spread, and this is your USD Japanese yen currency. They are generally correlated, as you see. If the spread is increasing, USD Japanese yen is increasing, because if US Treasury is higher relatively to the Japanese government bond, meaning that United States interest rate increasing. And if the interest rate increasing in one country, because of the Fisher effect, your domestic currency will depreciate, and for the country who is increasing their interest rate, their domestic currency will be appreciated. When the spread is going in favor of the United States, USD is gaining strength. Japanese yen depreciating here. On the right-hand side, this is the net short position, meaning that how people selling Japanese yen. Short position means this. How people selling the Japanese yen, number of contracts. This is the derivative market. This is not the spot market. Okay. How people selling the Japanese yen in derivative market. And this is the USD Japanese yen, as you see. Okay. And here the net position. It is also generally correlated. If people selling more position, net short position on, this is the black one, net short position on the United States Japanese yen, this is inverse. Please focus on this. This meaning that if this increasing, Japanese yen is depreciating. Okay. Now we are on the giant, the biggest giant, the new giant in the world, the China. The China is the rising power on the world. Normally between 2010 and 2020, their economy each year growing approximately 6 or 7%. What does this mean us to? For instance, let's take some countries in MENA region, like Turkey, like Saudi Arabia, like Egypt, or like Bulgaria, Hungary, or some countries in the EU. Their domestic product is less than 500 billion. For instance, for Turkey, it's approximately $1 trillion. The whole country, just $1 trillion GDP. And the China with $30 trillion GDP, if they increase their growth each year 6%, meaning that they are growing every year 2 times higher than the whole Turkey. Do you understand what is the basic logic behind it? Every year, China can birth a new country. It is huge. Your country and your economy can be really big. But if your growth rate also big, then nobody can reach your speed. Nobody can stop your growing power in the world. And on the left-hand side, like we did, my internet connection is a little bit decreasing. I will just, let me do this. Please don't move your mouse on the screen, and I'm closing my camera to increase my speed. Sometimes it is freezing, my mouse freezing. Please don't move your mouse. Okay, this is my ultimate request. Thanks. Here, please focus on, wait, I will decrease this page. Let's take this page to here. Yes. Here on the left-hand side, I have the China GDP and inflation. And normally, here as you see, please look at this subcategories in the China side. What is meaning by this? This chart showing us that what is the subcategory and what is the source of growth in China. Normally, like we did in the GDP and inflation, like in the Japanese case, we are doing the same for the China as well. And what is the dramatic point for us? As you see here, the orange is real GDP. Please look at these years. Do you see what I said a few minutes ago? China is growing every year around 6%. And this is higher than every year. Just the growth rate is higher than a domestic GDP of a country. This is unprecedented. Your country can be really big, but if your growth rate also big, it is fantastic. And here, the black bar is consumption, the dark blue is investment, and light blue is the net export. For instance, focus on the days between here. Normally, between after the global financial crisis of 2008 until the COVID crisis, China is growing with investment and consumption. And generally, most of the growth is coming from the consumption side. But now, growth is decreasing to the 5%. However, the investment is decreasing. Please look at the portion of the investment. It is really small. But now the net export is really growing in the GDP of the China. If the net export increasing, your trade connection with rest of the world is increasing. For that reason, United States will try to decrease your fee. On the right-hand side, if this left side is GDP and there's source of the GDP, and if the inflation is right-hand side, this black one, consumer price inflation, this light blue one, producer price inflation, and the dark blue one is the United States imports. Y-axis is year-over-year percentage change, and the x-axis is the time frame, again, from 2005 till now, meaning approximately 20 years. As you see here, there is two crisis periods, one and the second. These are the global financial crisis of 2008. This is the COVID-19 crisis, and the prices is decreasing. But normally, where is the consumer price inflation is stable? Around 2% here. But now, what is the problem for China? It is the deflation, because there is no 2% inflation anymore for China. The prices is decreasing. What I said a few minutes ago in Japan case, I said during 20 years, Japan economy is like in a recession. There is no inflation, there is no growth, and something like that. And now the China is like replacing for Japan in Asia Pacific. Their growth rate is decreasing and their inflation is almost zero. Okay, the economy, I think, reached the steady state rate of the growth. The speed is decreasing. Economy is not as hungry anymore. Okay, it eats more and much, and hunger is gone out. And now let's focus on the investment side for the China. Fixed asset investment year on year. Here, this is the percentage change again, and the x-axis showing the years. And China is like a communist country. The private sector is important, but state-owned enterprise is more important in China. And state-owned enterprise is the sources of the fixed asset investment, approximately 8%. And the private here, please look at here, private is almost zero right now. Private is converging to zero. And total, the average is around 5%, fixed asset investment. And if the state-owned enterprise and private sector doing this fixed asset investment, where this investment is going? Dark blue is infrastructure, light blue is manufacturing, and black one is real estate. And today, everybody on the news and the TV screen speaking about the real estate crisis in China. This is the graph of this crisis. Normally, the China real estate market until the COVID-19 crisis increasing 9 and 10%. With the COVID, it's shrinking. Then with the recovery process, it increase. But from then on, please focus on here and just focus on this black line. This black line decreasing steadily without stopping. Every year and month, it is decreasing. Because the interest rate and because the expectation for the next couple of years is worsening in the China, real estate market is crashing. And for manufacturing, it is stable. And for the infrastructure, it is less stable than manufacturing, but it is better than the real estate market. And the monetary policy and the credit growth for the China. This is the K policy rate of the People Bank of China. The black line is interbank repo rate. This is for 7-day, 1-week repo rate. The light blue is loan prime rate, and the orange is medium-term lending facility for 1 year, long-term financing, and loan prime rate 5 years. And what is dramatic here? The 5-year rate is approximately 3.5, and the loan prime rate, this is 1 year, it is approximately 3% now, and the short-term rate is even less than 2, meaning that China is cutting the interest rate because their inflation is really decreasing. An economy will not grow if the demand and total aggregate demand and people expectation continues like this. To fight with the worsening expectation, People Bank of China moving lots of facility for the market. Injection of the new monetary policy instrument, decreasing the interest rate and 1-week repo rate, decreasing the reserve requirement rate for the banks. They are putting lots of prudential measures, and they will see their lag effect for the next couple of months, but we will just focusing on the China and their real estate market for these days. And the credit impulse. To create the inflation, they are putting lots of credit to the market. The black one is aggregate financing. This one is bank loan. Purple is government bond. Orange is direct corporate financing and off-balance sheet financing. This is derivative market, this green line. And here, this is year-over-year change and percentage of nominal GDP. Normally, as you see, credit growth is minus. But right now, as you see, the credit growth here, positive, and it is increasing. Ladies and gentlemen, please don't move your mouse on the screen. Here you are putting some sign and I couldn't focus on the charts and slides, please. And now, as we say, our focus on is China real estate market, property market. Lots of the people on the world following what is happening in China's property market and whether this shrinkage, this illness, this negative side shocks can widespread and have a contagion effect for the rest of the world. They are wondering this market. For that reason, please look at this one. House prices for the China year-over-year change from 20% after the COVID crisis. Now, the Chinese house price almost in all subcategories. Floor space started, floor space sold, primary household, and secondary household. All is minus, meaning that real estate market giving alert to the rest of the world. Don't forget, global financial crisis in the 2008 started with the subprime mortgage. If China real estate market crash, this can create again a mortgage and subprime style crisis in the world. On the right hand side, housing inventory. You are building houses and you are selling. If you are not selling, they are in inventory. Please look at the inventory in the market. It is increasing every month and every day. Inventory is increasing because people not buying the house in the China. And this is the last country for us for the GDP, inflation, and macro indicator. This is Australia. The economic growth and the composition of the GDP. Australia is stable. They are really growing growth, 2% growth. They are managing the macroeconomic shocks well. The most of the real GDP growth is coming from the fiscal policy side, government spending. Please focus on this. Biggest portion is government spending and the private investment, but they are stable. Their economy is stable. Real GDP trend, as you see, the trend growth is 2.9. And today, the trend growth is here and the reality is here. Even the Australia is growing less than their trend. And last slide for the Australia and today topic is the consumer price inflation and core inflation in Australia and inflation component. Core CPI from, let's say, 40 years, core CPI average is 3%. And today, we are less than the average. And for headline inflation, it is 3.1 again. In the first quarter and in May of 2025, even it is less than the average. So they are managing the inflation and the price shocks better than their comparable countries. And what is the inflation component? Where this inflation is coming from? Please focus on here. As you see here, the biggest part is coming from this food. Food inflation is still alive in the Australia, and the services, like rest of the world, is fighting with services inflation. The biggest part coming from food and the services inflation. And the negative side, energy, because the petroleum price is decreasing. For that reason, energy inflation is minus. It is disinflationary period. And like housing or rents is subtle, small, but they are fighting